Welcome to On Course Financial, charting your financial future. This is the podcast for people who want clarity and confidence in their financial decisions. I'm Chris Brumlow. I'm a partner with the BAB Group. I'm a financial professional and an investment advisor representative, as well as retirement planning specialist. The BAB Group is a proactive accounting and wealth management firm focusing on individuals and small business owners to provide holistic advice when it comes to navigating their financial futures. We help those individuals and business owners understand their numbers, connect them to real decisions, and use them to plan for the future, not just react to the past. In our podcast, this is where we talk about the real intersection of business, taxes, retirement, and life planning. Each week, we focus on helping small business owners and individuals make clearer, more confident financial decisions without hype and without the guesswork. Roth conversions, strategy, not a silver bullet. Roth conversions are one of the most talked about strategies in retirement planning and one of the most misunderstood. Some people hear Roth and assume it's automatically good. Others hear pay taxes now and assume it's automatically bad. The truth is, Roth conversions are neither a magic solution nor a mistake by default. They're a strategy. And like any strategy, they only work when used intentionally in the right situation for the right reasons. What really matters about Roth conversions is where you feel taxes are going to be in the future, 10 years from now, 20 years from now, 30 years from now. If you think they'll be higher, Roth makes sense. If you think they'll be lower, tax deferral is your best course. And if they remain the same, it doesn't matter. Today, we're going to talk about Roth conversions, when they make sense and when they don't, and how to think about them as part of a bigger retirement income plan. I'm Chris Brumlow. I'm a partner with the BAB Group. I'm a financial professional, an investment advisor representative, and a retirement planning specialist. The BAB Group is a proactive wealth management and accounting firm that works with individuals and small business owners to provide holistic, tax-centric advice when it comes to navigating their financial futures. It helps people understand their numbers, connect them to real decisions, and use them to plan for the future, not just react to the past. First, let's understand what Roth conversions are and what is different than standard contributions to a Roth IRA. Let's talk about that Roth IRA. Roths have rules. First of all, to contribute to a Roth account, you must have earned income. Secondly, if you're under 50 years old, you can contribute $7,500 a year and an additional $1,100 per year per person if you're over 50 as a catch-up contribution. Finally, you can't earn too much money. Single filers with incomes over $168,000 can't contribute to a Roth IRA, and married couples with incomes over $252,000 can't contribute to a Roth. Now, Roth conversions are different. There's no income limit. You don't have to have earned income. There's no age limit, and there's no annual limits about how much you can convert. Roth conversions get attention for one simple reason. They promise tax-free income later. And that sounds incredibly appealing, especially in a world where tax rates are at a historical low, national debt is high, and future tax policy feels at the best uncertain. The idea is straightforward. You voluntarily move money from a tax-deferred account, like an IRA, to a Roth account. You pay taxes now for the monies that you convert. In exchange, future qualified withdrawals can be tax-free, and the growth in the account grows tax-free. That's powerful. But power without context can be dangerous. Now, the big misconception we see is this. If Roth conversions are good, should I convert as much as possible? And that's where people get in trouble. A Roth conversion is not a goal. It's a means to an outcome. The real questions aren't, can I convert? Or should I convert everything? The real questions are, what am I converting? What problem am I solving? What's the right amount to convert over what amount of time? And what am I giving up to do those conversions? What a Roth conversion actually does? Well, let's strip that down to the basics. A Roth conversion creates taxable income today in exchange for potentially tax free income later. So every conversion is a decision, it's a trade off between today's tax rate and tomorrow's unknown tax rates. That's the big unknown. That means Roth conversions live at the intersection of tax planning, income planning, and timing. And without that context, they're just a tax bill. Now, when Roth conversions often make sense, there are situations where a Roth conversion can be extremely effective. For example, in years with unusually low income, in early retirement before Social Security or RMDs start, when someone expects higher future tax rates, when reducing the future minimum required distributions is a priority, when managing Medicare premiums or Social Security taxation. In these cases, conversions can smooth income over time, reduce future tax pressure, increase flexibility later in retirement. Notice what all these have in common. They're about control, not tax avoidance. It's about the knowns of today's historically low tax rates against the backdrop of future unknown tax rates, especially given the fiscal conditions of our country and its unfunded obligations, such as Social Security and Medicare. When Roth conversions may not make sense, there are also situations where Roth conversions can do more harm than good. For example, converting while still at your peak earning years, pushing yourself into a higher tax bracket, triggering higher Medicare premiums unintentionally, paying taxes from the converted assets themselves, or converting without a clear income plan. In those cases, you may be simply prepaying taxes unnecessarily, reducing liquidity and limiting flexibility. That's a strategy. That's not a strategy. That's a reaction. It's important to understand that you shouldn't have all your eggs in any one basket. And the real planning comes in knowing the right amounts to have in which taxable buckets: your tax now, your tax later, and your tax never buckets. Now, Roth conversions and retirement income. Here's where Roth conversions really belong in the conversation. They're not about maximizing account types, they're about designating income. A well structured retirement income plan asks which dollars will fund essential expenses, which dollars are flexible, which dollars help control taxes year by year. Roth dollars can be incredibly valuable during market downturns where you don't have to unnecessarily pay extra taxes for using those dollars as a part of an overall strategy to minimize Social Security taxation, or in years when other income spikes, or when you're managing tax brackets intentionally. They don't replace an income plan, they support an income plan. Roth is not a silver bullet. No one investment is a silver bullet. They're all tools to a plan. And here's the honest truth: Roth conversions don't eliminate taxes entirely. They don't protect you from all future risks that you may face or guarantee better outcomes in and of themselves. They are one lever among many. When people focus too heavily on Roth conversions, they sometimes miss the bigger picture: cash flow, income reliability, market risk, longevity, and lifestyle goals. And retirement success doesn't come from winning the tax game in one year, it comes from coordinating those decisions over many years. Now, the right way to think about Roth conversions is this: they're a planning tool. They're used strategically, they're used over time, they're used with intention. The goal isn't to avoid taxes forever. The goal is to pay taxes at the right time at the most reasonable rates while preserving the flexibility and income security. That's what a strategy looks like. I'll leave you with this: Roth conversions can be incredibly effective, but they're not automatic. They are not universal. It requires planning and coordination with a tax professional and understanding your tax brackets and your incomes year over year over year. At the BAB Group, we believe the best retirement strategies are built individually, not copied. So don't just ask, should I do a Roth conversion? Ask, what role does this play in my overall retirement plan? And how does it actually improve my long term flexibility? Thank you for listening to On Course Financial, Charting Your Financial Future. Join us next time as we'll continue to break down strategies that matter and helping you stay on course. As a reminder, the information shared in this podcast is for general educational purposes only and is not intended as tax, accounting, investment, or legal advice. Every situation is unique, and decisions should always be made based on your individual circumstances. If you have questions on how these concepts apply to you, we encourage you to consult with a qualified tax professional or reach out to us. Remember, clarity leads to better decisions, and better decisions lead to better outcomes in business, in retirement, and life. Our goal with this podcast is to educate, inform, and help you think more clearly about the financial choices you have in front of you. Thank you for listening to On Course Financial. Join us next time, and we'll continue to share ideas, insights, and strategies to help you move forward with confidence and stay on course. I'm Chris Brumlow. Thank you for listening.